Normally, financial markets kind of obey the laws of physics. Like
Yeah.
when interest rates go up and transaction volumes drop, well, prices are supposed to fall.
Right, exactly. It's basically financial gravity.
Yeah. You look at the data, you see the trend line, and you expect a totally predictable outcome. But in Singapore's ultra-prime real estate market right now, in May 2026, gravity has just, well, it's basically stopped working.
It completely has.
So today we are opening up a stack of wealth management briefings, um, property intelligence reports, and the latest expat relocation guides. And our mission for this deep dive is to figure out why an island with plunging transaction volumes is suddenly seeing, like, $38 million price tags on a single home.
Yeah, which is just a staggering number to see right now.
Okay, let's unpack this, because the headline that absolutely grabbed our attention today is this freehold good class bungalow, or GCB,
Yeah.
at Bukit Tunggal in District 11 that just hit the market.
Right, and we should clarify for everyone, we aren't talking about penthouses and glass skyscrapers here.
No, not at all. We're talking about these sprawling, leafy estates hidden behind massive gates. Places where the land itself is honestly worth way more than the mansion sitting on them. So tell me, why is a single $38 million price tag the perfect lens for understanding this entire high-end market right now?
Well, because that $38 million figure, it's essentially a diagnostic tool for the psychology of the ultra-wealthy. If we ground this in the data you provided, this specific listing sits in the Caldecott and Thompson Road cluster.
Okay.
And based on the plot sizes there, that $38 million translates to an implied land rate of about $1,700 to $2,100 per square foot.
Wow, wait, so just for the land?
Exactly. We need to really clarify what that means. In the landed property world, the value isn't really in the bricks and mortar of the house at all. It's the dirt underneath it.
So buyers are essentially paying upwards of $2,000 for every square foot of pure earth.
Yeah, pure earth.
Which is an astronomical premium when you consider the sheer acreage of these plots. But here is where my brain just kind of gets stuck.
What do you mean?
Well, in all of 2025, there were only 36 GCB transactions across the entire island. 36.
Yeah, it was incredibly thin.
Right. And that included some massive outlier deals like the Pierce Road sale that went for $148 million for an 80,000 square foot plot. So the transaction volume is undeniably thin.
Highly illiquid right now, yeah.
So if transaction volumes are so much thinner now than during the absolute frenzy we saw back in 2021, shouldn't sellers be slashing prices? Like, is this like the high-end art market where the owner of a rare Picasso just refuses to sell for a penny less than they think it's worth, completely defying normal supply and demand?
You know, that art market analogy captures the dynamic perfectly.
Really?
Oh, absolutely. We are dealing with extreme scarcity here and a buyer pool that just doesn't rely on standard bank financing. They don't care about mortgage rates. There are basically three structural mechanics keeping these prices in the stratosphere right now.
Okay, lay them out for me.
First is zoning scarcity. There are only about 2,700 to 2,800 GCBs in existence in Singapore. And because of the Urban Redevelopment Authority's strict zoning laws, no new GCB land can ever be created.
Right, ever.
Ever. The pool is permanently capped. You literally cannot build a new one unless you tear an old one down.
So it's the ultimate limited edition asset. You are buying into a club that has permanently closed its membership book.
That's exactly it. And the second thing is the replacement cost logic. Buyers at this level aren't just looking at the per square foot price in isolation.
Right, they're looking at the big picture.
Yeah, they're looking at the impossible mechanics of trying to assemble a landed plot of that size in District 11 today. Like, if you buy an older GCB and want to rebuild it, you are looking at skyrocketing construction costs, massive planning hurdles.
And it probably takes years, right?
Oh, multi-year timelines easily. When you price in the cost of materials, the struggle to secure specialized contractors, and just the time value of money, the replacement cost effectively sets a massive price floor.
Yeah.
So that $38 million tag starts to look like a mathematical baseline rather than some crazy premium.
That reframes the entire data set. You literally just cannot recreate it for less.
Exactly. And the third mechanic is wealth concentration and legacy demand. These $38 million purchases, they're multi-generational wealth plays.
Like passing it down to the kids.
They're the grandchildren, yeah. If you are buying a family legacy asset, you really don't care what the benchmark interest rate is doing this quarter. And what's fascinating here is how government policy is actually interacting with this wealth structuring.
Right, because the sources highlighted that recent Ministry of Finance clarification, the one regarding the additional buyer's stamp duty, or ABSD, specifically for non-strat assets like GCBs.
Yes.
Let's
Exactly.
actually pause there and define that for you listening, because this was the rule change that had all the wealth managers totally buzzing in the reports. So what is a non-strata asset, and why does this ABSD clarification matter so much?
Okay, so strata assets are properties like condominiums, where you own your apartment, but you share the title for the land and the common areas with everyone else in the building.
Like the pool and the gym.
Right. Non-strata means you own the property and the physical land beneath it outright, completely yours.
Got it.
Now, for a long time, if a billionaire patriarch wanted to put a massive non-strata asset like a GCB into a family trust, it was a massive headache.
Because of the taxes.
Yes. The government would basically look at the trust and say, well, we aren't entirely sure who the ultimate beneficiary is, so we might just hit you with a massive, unpredictable tax bill.
And billionaires hate uncertainty far more than they hate taxes.
Precisely.
Yeah.
They want a plan. So the new Ministry of Finance clarification provides a really clear mathematical formula for how the ABSD is applied when these properties move into family offices or trusts.
Oh, so it turned a risky tax gamble into basically a predictable spreadsheet exercise?
That's exactly what it did. By giving these family offices ABSD certainty, it removes a massive friction point. It's essentially greasing the wheels for multi-generational wealth transfer at the very top.
Which just further cements GCBs as a hyper-efficient, tax-predictable vault for citizen wealth.
Exactly.
Okay, so if $38 million is the floor for the absolute elite, and the government just made it easier to keep that wealth in the family, what happens to the domestic millionaire who has, say, 3 or 4 million to spend? I mean, they obviously can't buy a GCB. Where's that money going?
Well, it is funneling directly into the luxury condominium market, specifically the core central region, or CCR.
Okay, so districts 9, 10, and 11.
Right. Your traditional prime luxury areas, Orchard Road, Bukit Tunggal, Holland Village. According to the Q1 2026 data we have, CCR prices actually rebounded, going up 0.6%.
Which defies that gravity we were talking about earlier.
Exactly. But the critical mechanism you need to understand here is the supply clash. New private home supply in the CCR is dropping by 28.6% in 2026.
Wow, almost 30%.
Yeah, that leaves just 870 units. And it tightens even further in 2027, dropping down to an estimated 1,395 units.
So the pipeline's basically drying up. But here's where it gets really interesting. I was looking at the price comparison data in our sources.
The RCR gap.
Yes. The price gap between this ultra-prime CCR in the city fringe, which is known as the rest of central region or RCR, has narrowed to just 10%. A 10% gap is a 30-year low.
It's wild.
It's like flying on an airplane, right?
Yeah.
Historically, upgrading to first class cost like 3 times the price of economy. But right now, because of this weird market distortion, upgrading to first class only costs 10% more.
And of course, locals are snapping up those seats.
Right. But why is the premium shrinking if supply is drying up? That feels backwards.
Well, it all comes back to a complete change in who is actually doing the buying. We have to look at the 60% ABSD that was applied to foreign residential purchases.
Ah, the massive tax hike.
Yeah. That policy fundamentally wiped out the foreign speculative buyer, the guy who used to blindly pay that massive premium just for a District 9 address.
Just to park their money.
Exactly. Before that tax hike, foreigners made up about 14% of the CCR condo market. Now, they are down to just 5%.
Wait, 5%? That is essentially zero in a global hub like Singapore.
It is. It really is.
That fundamentally changes the identity of these luxury buildings, doesn't it? Like, they aren't international investments anymore. They're just local neighborhoods now.
Yeah, the tax did exactly what it was engineered to do. I mean, think about it. If I'm a foreign investor looking at a $3 million condo, that's a $1.8 million tax bill just to get the keys.
Wow. That just completely destroys the investment math.
It destroys it. So the person buying that first-class seat, as you put it earlier, is entirely different today. It's the HDB upgrader or a local wealth preserver.
Right. And just for you listening who might be outside Singapore, an HDB upgrader is someone moving from government-built public housing, which houses the vast majority of the country, into the private market.
Yeah, and those HDBs often appreciate significantly over time. So this isn't foreign tech money flowing in from abroad. This is local ground-up wealth stepping into the luxury space.
And because they are local, they don't look at District 9 in a vacuum the way a foreign investor might.
Yeah.
Right. A buyer in Shanghai or London just wants the famous postcode.
Exactly.
But a local buyer is comparing that CCR condo directly against a city fringe RCR condo in a place like, say, Queenstown or Bishan. They are weighing the space, the proximity to good local schools, the layout.
They are highly, highly pragmatic. They are looking at a $2.5 million budget and just doing the math. Like, do I want a slightly smaller, older unit near Orchard Road, or do I want a massive, brand new unit just 10 minutes further out?
Yeah.
And because of that pragmatism, they just weren't willing to pay a 30% or 40% premium just for the prestige of the CCR. That refusal basically forced the prices between the two regions to converge to this 10% gap.
But, reading the projections in the reports, this narrow 10% gap seems like a rapidly closing window of opportunity.
Oh, it definitely is.
The sources project that upcoming new launches, like that massive Bukit Turf City project coming in late 2027, will launch at $3,000 to $3,300 per square foot.
Yes, the luxury market has been temporarily democratized for the domestic buyer, but the clock is absolutely ticking. Once those massive new projects hit the market at $3,000 plus per square foot, the benchmark resets entirely.
And that 10% gap just vanishes.
Exactly. The local buyer is currently looking at the most affordable relative premium to live in a prime district that we've seen in 3 decades, but the window is shutting fast.
Okay, so looking at this data, the obvious assumption is that landlords must be making a killing right now. Like if I'm a foreign tech executive or a finance director locked out of buying by that punishing 60% tax, I still have to live somewhere.
Right.
So I must be flooding the rental market. But, reading deeper into these relocation guides, there's a weird contradiction. The foreign buyers are blocked, but tenant leverage is actually up. Walk me through that math. How can tenants have the upper hand when they have absolutely no choice but to rent?
This raises an important question, actually, about the difference between demand and available inventory. You would assume landlords hold all the cards, but the expat rental market has completely normalized.
Wait, really? Normalized how?
Well, tenant leverage is at its highest point in 3 years purely because of the supply side. We had a massive wave of condo completions across 2024 and 2025.
Oh, right.
Yeah, all those delayed pandemic-era construction projects finally secured their permits, finished building, and literally hit the market all at once.
So it's not that demand dropped, it's that the sheer volume of available apartments spiked so hard it overwhelmed the demand.
Exactly. That influx of new inventory completely restored the market balance. The era of landlords demanding 30% above market asking rents and actually getting it without even doing a viewing, that's over.
Wow, so the panic bidding wars of 2023 are officially dead. Let's provide the exact 2026 benchmarks from the relocation guides then. What does it actually cost to rent in these prime areas right now?
The rates have stabilized nicely, which is giving expats a lot more predictability. For a core central region one-bedroom apartment, you are looking at $3,800 to $500 a month.
Okay, what about families, like 2 or 3 bedrooms?
A 2-bedroom will run you $5,500 to $8,500, and a family size 3-bedroom is sitting between $8,000 and $15,000.
That's quite a range.
Yeah, it really depends on the age of the building and the proximity to an MRT station.
What about that city fringe area, the RCR, that we were talking about earlier with the local buyers? How are expats viewing those neighborhoods?
That is where the expat behavior is really, really shifting. RCR 2-bedrooms are currently renting $4,500 to $6,500. The relocation guides explicitly call this the ultimate value sweet spot.
Oh, I like that, the value sweet spot.
Yeah. Expats on multi-year assignments are realizing they just don't need to live right on Orchard Road. The psychology has changed. They're prioritizing square footage, proximity to green spaces, and access to international schools over pure CBD centrality.
Because they want that extra bedroom for a home office, and they're willing to take a 15-minute commute to get it.
Exactly. If you are paying $10,000 in Orchard, but $6,000 in Queenstown gives you a home office and a bigger balcony, the math makes a commute totally worthwhile.
Makes total sense. So we've got a lot of listeners who might be on either side of this transaction right now. Let's walk through how they should be playing this market. Start with the tenants. If I'm an expat looking to rent, what are the actionable tactics right now?
The first tactic is really all about timing. You need to act now and lock in a 2-year lease at these current stabilized rates.
Why the urgency?
Well, the relocation reports note that corporate relocation seasons usually heat up heavily in the second half of the year. When that fresh wave of executives arrives in H2 2026, it could absorb this excess supply and tighten market all over again.
So use a current window of high inventory to your advantage while you can. What else?
Use your leverage in the contract terms. You should push hard for break clauses. For example, ask for a 6-month break clause on a 24-month lease.
Meaning you can exit the contract after 6 months without a penalty if your job relocates you.
Exactly. 2 years ago, a landlord would have literally laughed at that request. Today, they are much more open to it. And finally, ask for minor furnishing upgrades before you sign anything.
Like what?
Request fresh paint, updated appliances, or even a new mattress. Landlords are currently very motivated to accommodate these requests to avoid extended vacancies.
You actually have the power to ask for a new washing machine without being laughed out of the viewing.
Ah.
I love that. Okay, flip side.
Yeah.
What if I'm the landlord? If the tenant has all the leverage right now, how do I compete without just totally slashing my asking rent?
You have to differentiate your unit beyond just the address. You can't rely on the postcode anymore. Focus heavily on condition and lifestyle amenities.
Right, because of the WFH shift.
Yeah, the relocation guides stress that if you have a study room, make sure it is explicitly marketed as WFH compatible. Show that it has good lighting, space for a proper desk, and upgraded internet infrastructure. But the biggest tactical advantage, honestly, according to the sources, is becoming pet-friendly.
Ah, the pandemic puppy effect.
Precisely. A huge portion of the expat pool now has pets. If you allow pets, even if you require an additional security deposit to cover potential damages, you instantly access a wider pool of tenants.
And probably a better pool.
Right. Well, more importantly, you access a much stickier pool of tenants.
Stickier, yeah. Because think about the psychology of moving a family and like a golden retriever halfway across the world. The hassle is immense.
It's a nightmare.
You have to deal with vets, import licenses, quarantine regulations, and then on top of that, finding a landlord who actually accepts a dog. By simply allowing that dog, you aren't just filling a vacancy, you are basically buying tenant paralysis.
Yes, they will never want to move again.
That dog is the greatest retention strategy a landlord can have right now.
Yeah.
I mean, they will gladly accept a rent increase in 2 years just to avoid putting the dog through another move.
That is exactly the mechanism at play. The friction of moving with a pet ensures long-term occupancy, which is the ultimate goal for a landlord in a high-supply market.
So what does this all mean for you when you step back and look at the whole board? We started with that $38 million GCB in District 11, which shows us that the very top of the market operates like this impenetrable fortress of domestic wealth.
Right.
And by clarifying the tax rules for family offices, the government has essentially greased the wheels for this wealth to be passed down hyper-efficiently. And because those GCB buyers are locked in, the next tier of local wealth is trickling down to stabilize the CCR condo market.
It's all connected.
Yeah, we are watching a historic supply crunch meet local buyers who are snapping up prime real estate at a 30-year low premium. Meanwhile, the foreign expats who used to buy those CCR condos have been entirely walled off by the 60% ABSD. So they're funneling into a rental market that paradoxically gives them all the leverage because of a massive wave of new apartment completions.
If we connect all of these mechanisms to the bigger picture, it reveals a fundamental identity shift. The entire DNA of Singapore's prime property market has transitioned.
Changed completely.
It used to be a playground for global speculative capital,
Right.
where foreign money dictated the pricing and the development trends. Now it has become a highly regulated, highly insulated safe haven specifically for domestic wealth preservation. The market has been entirely localized by policy design.
Which leaves us with a really fascinating implication to ponder as we wrap up. If the 60% ABSD has effectively turned prime real estate into an exclusive, gated club for citizens and permanent residents, what happens a decade from now? When this massive locked-in domestic wealth secured in $38 million bungalows and prime District 9 condos starts passing down to the next generation, completely untouched by foreign competition, are we looking at the birth of a permanently insulated property aristocracy? Think about that next time you walk past the District 11 bungalow and wonder who lives behind those gates. Thank you so much for joining us on this deep dive into the source material. Keep learning, keep questioning the trends, and stay curious.